Hello everyone and welcome to Investment News TV. My name is James Burton and I'm here in Denver at the Schwab Impact 2025. Very delighted to be joined by Ed Lopez, Head of Product at VanEck's. Ed,
Hey, thank
welcome.
you for having me.
Broad question, what trends are you seeing? What are advisors talking to you about? What do they want?
So many trends in the market today. Privates has been a big one, private access or alternative ways of getting private access. AI has been a big trend as well, and some of the knock-on themes that come with AI. And then emerging markets and de-dollarization. I should probably classify it that way. De-dollarization, which leads to gold, emerging markets, Bitcoin even. So
Yeah, let's pick up on that last point there, de-dollarization. Sounds an interesting term. What's driving it? And what does it mean people are wanting to move away from the US somewhat?
I think it's diversification away from the U.S. and de-dollarization in particular. I mean, you talk about on a geopolitical front, central banks diversifying their reserve currencies away from the U.S. After Russia invaded Ukraine, you saw what we could do in terms of blocking out certain countries from the SWIFT system, things of that sort. I think that led countries to kind of wake up and think maybe we need to have our reserves diversified. And so I think that's leading a lot of central banks to do just that. And you've seen central banks buying tons of gold. That's where you've seen the support for a lot of gold prices more recently over the last few years. But now this also plays into emerging markets to the extent that the dollar is weaker on a relative basis. Means there could be opportunities for emerging markets, emerging market equities or bonds as well, but international markets in general.
Do you feel like advisors are ready to diversify away from the US a bit more, or maybe the end client is ready? Because it's a big step for a lot of people, right?
Yeah, it is, I think. And I think that's one of the hurdles with a lot of US investors. We have this home bias, and the markets here are pretty good. So, it's not too bad. But everybody recognizes the overweight of the US market into the top 7 or, 8 names, what have you. And the risks that come with that, even though the market continues to run. If you want to diversify, kind of protect that portfolio a little bit better, you might look at international markets in different ways. Emerging market bonds in particular, the countries have better fundamentals than developed markets, lower deficits, and central banks that are making the right logical decisions. So they're in a great position. And I think people should at least consider if you're an income investor, emerging market bonds or bonds outside the U.S.
Just to rewind slightly to your opening answer and mention private markets.
Yeah.
Just play a bit devil's advocate here. I know there's a trend and people are having access to maybe parts of the market they didn't previously have access to. But, if I'm an advisor and I've got a bunch of money in the S&P, it keeps going up, everyone's happy. Why bother with the more complex private markets?
Yeah, well, go back to my other statement where the S&P is dominated by some of the largest names and these overweights, and people are looking for diversification and potential returns. You're not getting that. You're not getting quality names in the small cap space these days. And where you're finding that is in the private markets. There's been a lack of IPOs, maybe until more recently, and it's all been locked up in the private market space. And so I think I understand the rationale for people wanting to find access or get access to the private markets, and I'm all for it. But maybe there's the right way to do it. We believe public vehicles may not necessarily be the publicly registered funds may not necessarily be the right way to do it, just because of the illiquidity profiles of some of the private funds that are out there. It might be better in evergreen funds, interval funds, things of that sort. So you're seeing a lot of development in that space. One of the things that we've done to help meet that need from a publicly registered vehicle standpoint is we have a couple different products that kind of play into that and provide exposure to that. On the equity side, we recently launched our VanEck Alternative Asset Managers ETF, GPZ. You say that GPs, as opposed to LPs, it's GPs. Yeah. And it provides access to the managers of private funds. It could be private credit, private equity, infrastructure, real estate. And we've heard from advisors, and actually this idea came from an advisor, that they're starting to question the efficacy of their private investments. Are they getting the returns that they really expected?
Yep.
And in some cases, the alternative asset managers are actually doing better than some of the funds that you might get on an average basis. So it made a lot of sense. It's seen some decent traction since June or so. And then one of the other ways we provide access to the private markets is through our BDC income ETF. This provides exposure to business development companies. And what these are companies that provide, it's a public registered vehicle, and it's a public access vehicle to companies that provide loans to the middle markets, private loans. And each of these companies have a diversified book of private loans, high yielding, more volatile. That's the caveat you got to be aware of, because you're getting daily marks on the trading volume of the BDCs. But it's another way of getting access to private loans in a diversified way.
Interesting.
Yeah.
Ed, thanks so much for joining us. Been great
Absolutely.
chatting, and yeah, I've enjoyed it.
Thank you very much.
Many thanks to Ed, and we'll see you next time on Investment News TV.